So welcome to the studio, Jimmy. First things first, I have to ask you about a recent Fitch report that said recent rapid credit growth in the Nigerian banking sector may give rise to a weakened asset quality and higher impairment charges if left unchecked. They said there's a rapid underlying credit growth of 30 to 66%, which is evident. Now, I'd love to know your take on this. When I read this, my eyebrows sort of raised because I didn't think that credit, especially to the private sector, had increased that much, and that posed that much of a challenge to our banking sector. What is your take on what Fitch is saying?
I think I kind of recognize your fears. There was a report last week by the Lagos Chamber of Commerce and Industry, LCCI, which is a major business coalition of the same private sector that Fitch raises credit growth about. And LCCI actually cried about the fact that small and medium-scale enterprises, SMEs especially, that credit growth to this sector was actually reducing and was affecting growth and employment. So I think the kind of credit growth we're actually talking about, which is what is responsible for the credit growth in the balance sheets of the banks, could actually be bordering around single obligor limits. The banks have stratified customer base right now. So you find out that the big AAA clients, the niche companies, the blue chips, the Dangote Cements, the mobiles, are actually able right now to increase risk assets credit from the banks, while small and medium-scale enterprises can't increase risk assets, so can't increase credit. So I think the issue right now is on single obligor limits. That's what we should actually be looking at. Credit growth, 30 to 40% may not be bad if it can be matched by deposit growth in deposit base, which is also growing. Banks are topping 1 trillion right now, crossing 2 trillion. But what we should be looking at is the single obligor limit. Are they flouting this rule? Are they exceeding the single obligor limits on their risk assets? Because if the LCCI is saying that small and medium-scale enterprises, and if the LCCI is saying that their members cannot access credit the way they used to, then I think that's a concern actually. So this credit growth we keep talking about, which isn't translating to growth in the economy, which isn't translating to employment, then we've got to ask ourselves, who is it going to? Is it the blue chips who are exceeding single obligor? So I think that's where the risk is, not just credit growth.
Well, thank you. So let's turn our attention to the markets now. As you know, a couple of results have come out recently. FCMB, we had ETI come out, and just now we actually had Cadbury come out. But let's first look at FCMB. Their results actually look quite good. We saw a year-on-year growth of 17% in its profit before tax. But apparently, these are below management's forecasts. In fact, PAT came in 11% lower than management's forecast, and PAT was at 5.31 billion naira from 5.31 billion naira to 6.71 billion naira. What is your take on these results? What stood out for you in FCMB's results?
I won't want to look at FCMB on a quarter-on-quarter basis for now, and I'll tell you why. FCMB is involved in the integration of FinBank's activities with FCMB's activities, so I rather want to judge them on a longer-term basis. Yes, the results were below management's forecast, not good enough, but I would like to see how they integrate on the long run with FinBank. I know that there's, because especially when you're looking at the staff attrition issues in these banks at this point in time. So I want to see how will they integrate on a long-term basis with FinBank, and how will it translate into longer-term viability of the institution, really. So that's what I want to look at, not just the short-term numbers. Fell below management forecast, wish it could be better, but yes, how well would they integrate FinBank into their operations?
But Jimmy, just looking at the numbers, there's one thing I did note, that we saw net loan impairment go from a negative, which is 1.7 billion naira, a negative of 1.7 billion naira in 2011, to positive 575.96 million naira in 2012. Now, it looks like loan impairment charges recorded a write-back this quarter. What is your take on this write-back we're seeing? And of course, broadly across the sector, have we seen something like this happening with the other banks?
Yeah, most of the other banks who were involved in the record provisionings are done. Many of them are actually done with the write-backs. So for me, it's not even a positive at this stage that they're still, they're just passing that phase, because you need to, everyone did the write-downs, people did the write-backs, and so they're still at the write-back phase, which means that they're a phase or two behind their contemporaries. So they need to catch up with the rest of the industry who are creating new risk assets from the deposits being mobilized. So most banks have actually, they had aggressive loan recovery teams.
Yes.
So I guess this is the FinBank bit of the recoveries we're seeing. So that's why I said I would like to look at them on a long-term basis and would like to find out. I hope the integration issues with FinBank isn't going to, cause some laggard effect on the new merged entity. Really. So.
What about ETI? I mean, that's another bank that we saw emerging. It actually merged with, integrated with Oceanic Bank. We saw, they released their results. We saw PBT down, PAT also down, but we saw revenues up about 106.87 billion naira. What do you make of these results?
Yeah, revenues were very good. Operating expenses were quite high. Profits fell. And you'd recall that ETI, Nigeria is actually contributes the most to ETI's global operations, and Oceanic Bank is actually, they acquired Oceanic Bank with the hope, with the aim, with the belief that that would help ramp up their retail deposit base in Nigeria, because Ecobank Nigeria wasn't doing too well. I'm not sure how well they've been able to. It doesn't seem to me that they've done so well in pushing out the new Ecobank message. I don't think they've done too well in ramping up deposits and risk assets from the retail market, the retail end of Ecobank, former Oceanic Bank. So the profit figures, the operating expenses figures, I'm actually quite bothered about, especially the operating expenses. Went significantly higher, which probably resulted in the lower profits as well.
Well, moving over to another sector, we also saw Cadbury release its half-one results actually a few hours ago. Turnover was at 16.1 billion from about 16.2 billion naira. PBT 1.6 billion from 1.077. PAT 1.065 billion from 766.313 million. Now, I have to say, it doesn't seem like there's much change except when we look at its profit after tax. So what really is your take on these results? I mean, we saw results come out from Nestle, fairly good. We saw Unilever release results that weren't so good. And now we have Cadbury in the consumer goods sector. What is your take on the direction we're seeing on what the results we're seeing for most of these companies, and of course on Cadbury specifically when it comes to its results?
I think Cadbury's results, if you look at their history, they've had a checkered history in the near past. I mean, the kinds of infractions we saw there. But if you look at this year so far so good, you talked of Unilever's results, not too good. Indicators dropped. For the first half of the year, so far so good, quite a number of industrials have reported lower earnings, and many of them are citing insecurity in the north. We're expecting same from PZ. So if companies who seem relatively stable at this point in time can be releasing lower earnings, I think I would celebrate an increase in earnings from Cadbury, however little it may be. They're introducing new products right now. The confectionery market, where they used to be king with all their products, they've actually, they're facing competition from more industrials, non-listed industrials in the market, Reckitt Benckiser and the rest of them. So they're trying to release new products. So I believe that with time, as these products, as they increase the marketing on these products, and as this, so hopefully we should see more revenues and earnings come from these new products.
Okay, well, thank you so much, Jimmy, for giving us your take on some of those results. That was Jimi Ogbobine. He's in research and corporate strategy with BGL.